It's midnight, and you're scrolling through real estate listings, and every single house that doesn't look like it's about to collapse costs $500,000. The kitchen hasn't been updated since 2004. The carpet is beige. The basement has fake wood paneling, and somehow the listing calls it a starter home. Meanwhile, you're sitting there doing mental math on your salary, wondering if you missed a massive promotion somewhere along the way, or if the entire housing market has quietly lost its mind. Spoiler, it's not you. It's the math. And the math is brutal. My name is Dave, and today we're going to calculate who can actually afford a $500,000 house in 2026. Not who the bank is willing to approve, but who can realistically afford it without turning their life into a long-term financial stress experiment. Because qualifying for a mortgage and comfortably affording a home are two very different things. In dozens of US markets right now, $500,000 isn't luxury pricing, it's baseline. That price gets you a fairly average house, around 1,200 square feet, 3 bedrooms, 2 bathrooms, maybe a small yard, especially if you're anywhere near a major metro area. The median household income in the United States is roughly $84,000. So we're asking households earning $84,000 per year to purchase homes that cost 6 times their annual income. If that ratio sounds extreme, that's because it is. But people will tell you it's doable. The mortgage broker says you're approved. Your parents bought a house on less. Social media is full of people claiming they figured it out. So what's the problem? The problem is that affordable has quietly been redefined to mean technically possible, not financially sustainable. Let's start with the down payment. The traditional advice has always been 20% down. On a $500,000 home, that's $100,000 in cash. The median savings account balance in America is around $8,000. That's not a small gap. That's a $92,000 gap. Even if you're disciplined and somehow manage to save 10% of an $84,000 income, about $8,400 per year, it would take you roughly 12 years to accumulate $100,000, and that assumes home prices don't rise in the meantime. They will. So most buyers don't put 20% down, they put down 5% or 10%. On a $500,000 home, 10% is $50,000, which is still significant but more common. Now you're borrowing $450,000. At current interest rates in the 6 to 7% range, that loan translates into a monthly principal and interest payment of roughly $2,800. And that's just the mortgage itself. We still need to add property taxes, which in many areas will average around $500 per month. Homeowners insurance can easily run $300 per month depending on location. Maintenance is the expense everyone forgets, but the standard rule of thumb is 1% of the home's value per year. On a $500,000 house, that's $5,000 annually, or about $417 per month. If you didn't put 20% down, you're also paying PMI, private mortgage insurance, which can add another $200 to $400 per month. Let's conservatively call it $300. When you add all of that together, your total monthly housing cost lands around $4,300. That's the real number, not the advertised mortgage payment, the actual cost of owning and maintaining the property. Financial advisors typically recommend spending no more than 28% of your gross monthly income on housing. Banks will often approve you up to a 43% total debt-to-income ratio. So let's reverse engineer it. If $4,300 represents 28% of your gross income, you need to earn around $185,000 per year. Even using the more lenient 43% threshold, you're still looking at roughly $150,000 in annual household income. Only about 10 to 20% of U.S. households earn that much, which means the majority of American households cannot comfortably afford a $500,000 home under traditional financial guidelines. That's not negativity, that's just math. But people are still buying these houses. Yes, they are. Let's look at what that actually looks like. Imagine a dual-income household earning $160,000 per year. After federal taxes, state taxes, payroll deductions, and retirement contributions, they might take home around $9,500 per month. Subtract the $4,300 housing cost, and they're left with about $5,200. Now layer in the rest of life. Two car payments could easily cost $800 per month. Car insurance might add $250. Gas, especially in car dependent areas, could run $300. Student loans may be another $600. Health insurance premiums that aren't fully covered by employers might add $400. Groceries for a household trying to eat reasonably well can hit $800. Utilities, internet, and phone bills could total $450. After all of that, they're left with roughly $1,600 per month. And that's before clothing, travel, entertainment, home furnishings, unexpected medical bills, or additional retirement savings beyond a modest 401k. They're spending nearly half their take-home pay on housing. They're not reckless, they're not irresponsible. They're buying what the market labels as normal. This is what being house poor actually looks like. It means checking your bank account before buying groceries. It means postponing new tires because you're hoping nothing else breaks. It means financing dental work. It means that one unexpected expense, a roof repair, a medical emergency, reduced work hours, creates immediate financial strain. Now scale that scenario down to a $120,000 household income, or $100,000, or the median $84,000. At median income, a $500,000 home isn't just tight, it's functionally impossible without significant outside help or extreme financial risk. Here's the part that makes this even more uncomfortable. No one in the transaction is incentivized to tell you this. Sellers price based on recent comparable sales. Banks approve loans based on default risk, not on whether you'll be financially comfortable. Real estate agents earn commission when deals close. Insurance companies profit from policies. The system is designed to get you into the house, not to ensure you thrive after you move in. And once you've signed the paperwork, you're locked in. Selling a few months later often means transaction costs, potential losses, and credit damage. So most people stay, even if they're stretched thin, because walking away is expensive. We've also normalized this level of financial strain. We call it adulting. We frame it as part of the journey. We tell ourselves that struggling through the early years of homeownership is simply the price of building equity. But equity doesn't help much if you're constantly stressed and unable to invest elsewhere. Since 1990, home prices have increased roughly 400%. Median household income has risen around 180%. The gap between prices and wages has widened dramatically. You can't budget your way out of that gap. You can't side hustle your way into a fundamentally broken ratio between income and asset prices. So what can you do? You can run the numbers honestly. You can decide that a $500,000 house doesn't make sense for your income right now. You can look at lower price points, different markets, or simply continue renting while building savings and investments. There is no trophy for stretching yourself to the edge of financial stability. Real wealth isn't just owning property. Real wealth is having margin in your budget. It's being able to invest consistently. It's being able to handle emergencies without panic. It's sleeping at night without calculating whether next month's payment will clear. If your household income is under roughly $140,000 and you're seriously considering a $500,000 home, you need to pause and run the full picture, not just what the bank says you qualify for. Approval is about the bank's tolerance for risk. Affordability is about your quality of life. Maybe your income grows substantially in the next few years. Maybe price is correct. Maybe you relocate to a more affordable market. Those are all possibilities. But right now, with current prices and interest rates, a $500,000 home requires a level of income and stability that most households simply don't have. You're not failing if the math doesn't work for you. You're responding to reality. And sometimes the smartest financial decision isn't stretching to buy what everyone else says is normal. Sometimes it's recognizing that the numbers don't make sense and choosing not to play a game that's stacked against you. All right, thanks for watching. Don't forget to like and subscribe for more finance videos. See you next time.